Hello everyone. My name is Martin. This is FIT Teach the Teacher assignment week 1. Today we're going to talk about CBDCs. CBDCs stand for Central Bank Digital Currencies, and by definition, they're a digital form of countries' national currency, and they're issued and backed by central bank. And unlike cryptocurrencies like Bitcoin, Ethereum, CBDCs are centralized and they're controlled by governments. They're basically designed to complement or replace physical cash. And good examples of central bank digital currencies are China, Nigeria, and Bahamas. China with digital yuan, Nigeria with e-naira, and Bahamas with cent dollar. Nigeria and Bahamas, they wanted to launch central bank digital currency to help uh, people without a bank. So more and more people can use financial services online. And Bahamas succeeded uh, in the development and in the use of central bank digital currencies. But Nigeria has a very low adoption rate, and many people still don't use it. It's used by less than 2% of the population. And China also succeeded in this case, and a lot of people use digital yuan in China. Now let's see at potential benefits of central bank digital currencies. First is faster and cheaper payments. This is done because we basically kill the intermediary, in this case, commercial banks, and therefore uh, currency is issued by the central bank. So transactions are with reduced fees, much lower fees than with commercial bank, and it's faster also because commercial banks they have an issue if you want to do a foreign payment to a foreign country or overseas to another continent. It usually takes a lot of time to settle, and I'm not even talking about trying to send the money to a foreign country on the weekend. It's also very hard. So, eliminating the intermediary, the commercial banks in this case, makes the transactions faster and cheaper. Then it's financial inclusion for unbanked population because instead of trying to find a commercial bank, they're basically banked, financed by the central bank. It's reduced cash handling costs. There are a lot of costs associated with physical cash, and by issuing a central bank digital currency, the government can lower their spending of handling physical cash. It's improved payment efficiency, very easy, better control over monetary policy. So in case of uh, financial crisis, if financial crisis happens, government can much easily make new policies or use some financial tools more effectively to affect the population and the economy. And it's reduced fraud and counterfeit money. That's basically problems with physical cash, a lot of counterfeit money and frauds. But there are also obstacles of development of CBDCs, such as privacy and cybersecurity. Privacy is the biggest concern of regular consumers because many people argue CBDCs can create a system where government authorities can easily track purchases, buying behavior, and everything about regular people. And there is hardly any individual freedom anymore, and it's all transparent. And the second concern of CBDCs are cybersecurity, because digital currencies, of course, should be protected from hackers and cyber attacks. and commercial banks often face this problem of cyber attacks and hackers. But if it's one bank, it's an individual business, but central bank digital currency, it's much bigger system than just one bank. And if there is a cyber attack or any problem related to hackers, it can disrupt payments on much larger scale. So yeah, those are two biggest problems, but impact on the society is huge. It's more digital and cashless economy. We're trying to reduce physical cash, easier government benefit payments, faster international transactions. I already discussed this. Increased financial transparency, which is also linked to the problem of privacy, but CBDCs have to find something in the middle that can satisfy people, but can also be transparent enough so government can use it. And there is greater dependence on digital infrastructure. So that's it for today. Hope you enjoyed this video. Have a good day.